Good afternoon, this is Todd Colvin coming to you from the floor of the CME Group. We are looking at rates and 10-year note yields inch ever higher back to the midpoint of the 100-day range. How about that? We got to 290. We've seen the market kind of hover here. We tested the 280 level now twice over the last month, failed, rallied to the midpoint, and now we've done it again. So we've seen this 280, 290 range trade before. We also have seen the 290 to 3% trade before and then revert back to the mean. So this 290 level seems to be a magnet. When we reach the outskirts, we come back to it pretty quickly. This last couple of days has been no different. We've rallied right 8 basis points in the 10-year yield since the recent lows were put in on Friday. So right now we're seeing a trade to the midpoint. You'd think volatility would be softening, and you'd be right, except for it's eerily sideways as we continue to kind of bounce in this middle of this range. It's been 100 days since we've seen that trade between 280 and 3%, and it hasn't really diverted outside of that range much, other than the initial, we saw that 3.01 settlement. But ultimately, it's been a very tight market, and the fact that we continue to hover at the midpoint of that range in Treasury yield, while the world around it, you look at yields in Italy, you look at what's happening with the lira, you look at what's going on, say, with trade talks with China, you look at the equity market seeing some moves, you see what's happening with the dollar. A lot of this is starting to create a little bit of volatility outside the Treasury market. Yes, we've seen shorter-term volatility decline and middle to longer-term 3-month volatility hold steady. But you think that there would be some kind of a bid to volatility here as risks are on the rise. And we know that as we get closer to more Fed tightenings, that'd be in September, December, there isn't a whole lot of clarity what happens after that, and that in itself should create some volatility. So volatility holding steady, a little bit too quiet for comfort, I think. And if you look, lastly, another reason why volatility I think should be higher, if you look at the yield curve, 210s traded below 20 not too long ago. Now it's back above 25, so we've really pretty much knee-jerked back higher, yet we haven't seen a reflection in volatility. When you go against the grain, that's when volatility tends to bid, or if there's some kind of catastrophic event or some kind of catalyst event, that in itself would cause volatility to bid. But right now we're seeing the yield curve steepen modestly. We've seen this before. I think perhaps the market is anticipating that will reflatten after we get some news, perhaps after we get non-farm payroll, perhaps after we get some of the later data next week. But ultimately, in the moment, volatility should be a little bit higher as 210s is steepened, taking us out of that flattening trend. Right now, yields holding the range, though, the 100-day range, right at 290, right in the middle. This is Todd Colvin coming to you from the floor of the CME Group.